It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Wow, I'm sure a lot of you are probably tuning in, wondering what I think about the results of the Virginia governor election, and of course New Jersey also, but you're going to have to wait till the next show because I got so much other stuff to talk about, obviously, and I do think those results are going to have some big impacts as far as our economy and our society and things going forward, of course. But what I want to focus on this show more about is our Federal Reserve has made a big decision this past week, very recently, and that is they have announced they are going to stop. They're going to start tapering their purchase of assets. Now, from an economic standpoint, this has actually been anticipated for a while, but still is very, very huge news, very big news. And the reason behind that is quite simple. Since roughly mid-2020, because of the COVID shutdowns and such, the shutdown of our economy, basically, the Federal Reserve just took a number of unprecedented measures, dropped interest rates back to the lowest rates ever, and started doing asset purchases. Now, what does that mean? Basically, what they've been doing is they've been buying $80 billion worth of bonds per month and then $40 billion of mortgage-backed securities per month, okay? And what that has done, and I think everyone recognizes this, it has boosted the stock market, and of course boosted real estate values. I've heard many people always say, don't fight the Fed, right? There's no question it's absolutely boosted those asset values, again, in the stock market and the real estate markets. I've been very critical of how much they've been doing and for how long, as have many people. I'm not the only one by any means, because, well, in many experts' opinion, and what we're seeing is this leads to a bubble, inflationary cycle, artificially boosting prices far too high, far beyond what they should be, therefore causing things like housing to become unaffordable for many people. Okay? The price of homes have gone through the roof. Rentals have gone through the roof for many reasons, but certainly the Federal Reserve purchasing $40 billion a month of mortgage securities certainly contributes to that in a big way. Now, what they're going to do is they're going to start tapering those purchases this month in November 2021, and they're going to end the tapering in June of 2022. So they're going to reduce the amount of purchases each month, or taper off, if you will, over the next roughly 8 months. So they're wanting to try to do a gradual decline, gradually get it out of the market. And I can understand some reasoning, the reasoning behind that. If they did an abrupt, just stop purchasing mortgage-backed securities or bonds, for example, we would most likely see a significant impact, a jarring impact, most likely in the markets, the stock market in particular, and the real estate market. So it's going to have an effect. To what degree, to how much, that remains to be seen. Based on experience, history, my opinion, I think it's going to have a fairly significant effect in both markets because, again, my opinion, and from history and just looking at things, I believe the Federal Reserve has been purchasing these assets and such, for far too long. It should have been tapered off some time ago. I would say at least probably 6 months ago, if not sooner, in my opinion. But, I'm one of those, I'm kind of libertarian in my views, as many of you know. I don't like a lot of government intervention or Federal Reserve intervention either. There's certain times for it. I get that. And when they first started to do it, when the economy was basically in free fall because of the forced shutdowns of the economy, basically, I understood the validity of it and the necessity. But again, my challenge with any government or quasi-government agency, and I put the Federal Reserve in that category, is they far too often they gain power and control by doing things, right? And so they often try to do too much. They do far too much is what ends up happening, and overcorrect, oversteer, if you will, and therefore creating additional problems in addition to the ones they're trying to solve. That's what, historically, that's just what we see on a regular basis. So will the Fed be able to unwind all of this in an orderly manner and not disrupt both the stock markets and the real estate markets too much? I think any reasonable person could recognize that there will be some effect. But again, to what degree, how much, again, that remains to be seen. It's certainly an uncertainty. We've never really had much experience with this type of thing. Some back from 08, 09 when they did this type of thing. But really, there's not been a lot of historical data or history. So they're kind of navigating almost in uncharted waters, if you will. So there's a lot of uncertainty in terms of how this tapering will impact the markets, which obviously I'm not saying this to be fearful or anything like that. I say this all the time: good times, bad times, in between. Diversification is often your key to navigating uncertain waters, and we're certainly in uncharted and uncertain waters here. There's no secret that the stock markets and real estate markets are at or near all-time highs. Seems like on a regular basis they've been breaking new highs consistently. But again, will that continue? I would have to, as the Fed tapers off their bond buying and mortgage-backed security buying, I would have to say that it's going to certainly be less likely that we're going to be seeing all-time highs. We could see some pullbacks, some corrections. We're going to see. But again, if by diversifying, I've had so many people say that to me, and it's true. Even when things are stable and good, uncertainties exist in life, right? I mean, there's just stuff happens, right? I always say stuff happens. And whether it's the economy in a macroeconomic manner or it's you individually, something happens in your life to change your financial situation. Oftentimes things completely out of your control. Diversification is a key method to mitigate that risk. And, modern portfolio theory has taught this since the 1950s, and many, many studies have shown this to be one of the most effective manners or ways to ensure that there's, to mitigate risk, I should say. And a rule of thumb, the modern portfolio theory has always said, 60-40 split is typically recommended. Again, somebody who's younger, maybe could handle some more risk, might increase the risk side. Somebody who's maybe a little older, closer to retirement, or more risk adverse, might go more to the conservative side. But 60-40 is a good rule of thumb to start. And again, modern portfolio theory talks about stock equities being the 60%, bonds being the 40%. But the thing is, as I state to people all the time, that more secure 40% or 50% or 30%, whatever it is, that doesn't have to be bonds. It can be any asset that has some guarantees, consistency, in other words, some steady eddiness. And certainly your personal bank fits that bill, fits that category. It does a lot of other things also, but it certainly does that with a strong, long-term, consistent dividends. It's still funny. I still have people telling me, as long as I've been on the radio and sharing this, we have companies that have been paying 6% dividends for last 25 plus years, never missed a dividend since literally before the Civil War. And I probably have said that probably on just about every show I've done for the last, couple of years or longer. And I still get people surprised by that. But it's a fact, folks. Absolutely. I'll show you the companies. Contact me at toll-free 866-268-4422 or yourpersonalbank.com. I'll share with you what companies are the top dividend payers. And then, of course, another way to ensure that you're offsetting like inflationary concerns and things like that, because we're certainly in that right now. And this is another thing. The Federal Reserve has, again stated today that inflation is, they've kind of stopped using the word transitory. In fact, some of the governors called it an evil word because it's not appropriate. They're saying they expect inflation to continue through 2022 certainly, and likely longer than that. So that's not transitory. They're stating that themselves, right? So my point is, a highly interest rate sensitive asset with long-term consistency, long-term history of paying solid dividends, that's a key here. Something that's interest rate sensitive, which will tend to pay more in a higher interest rate environment, or more of an inflationary type of environment, which tends to have higher interest rates and all that. That's a key thing. And of course, another big concern folks have today is about future tax rates. Some of these results, hopefully these political results recently, might mitigate some of that. We don't know yet. We'll know more certainly. Is the current administration going to jam through some tax increases while they still have control and are still in power, or are they not going to, or are these results going to impact their decision to not push things as aggressively? Again, unknown what's going to happen. And if the midterms do end up being a change of party in terms of who's in control of the House or Senate or both, that will have a big, significant impact on future tax rates, obviously. So, again, it's an uncertainty. Having something that's tax-free, grows tax-free, access tax-free, pass on tax-free, well, that's powerful, okay? And your personal bank obviously does that. So I'm going to talk about in the next segment another big issue, and that's interest rates. And that was another big part of the Fed announcement in terms of what they're going to do going forward. And I'll discuss some things about how, I believe it's going to impact our money, and our growth of our money, our economy, and how we earn it, keep it, pass it on to the next generation, right? We're at an inflection point, I think, after the Virginia race and the results of the most recent election. The American public, the majority of Americans, I should say, made a significant statement. We're going to see if that continues going forward. I'll discuss that more in the next show, so you're just going to have to wait. Like I said, I want to keep today's discussion a little more money focused, because there's a lot to talk about there, particularly with a lot of the things, again, that the Federal Reserve is doing. So, again, the tapering, I'm glad to see it personally. I think it should have happened sooner. It's created an asset bubble, a bubble in real estate and stock market prices. How much those are going to retrace due to the tapering of the bond purchasing and mortgage-backed security purchases remains to be seen, but it'll be an interesting ride as we go forward. So stay tuned to Your Personal Bank Show. Contact me at yourpersonalbank.com for more information, or toll-free 866-268-4422. And stay tuned in the next segment. I'm going to talk about interest rates.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And as I was starting to say earlier, the first segment is the Federal Reserve has come out with a major announcement very recently. And this is important for our economy going forward, so we really need to discuss it, because I don't think any reasonable person can argue that real estate and stock market prices have gone through the roof, and largely due to the Federal Reserve and their actions in terms of keeping extremely low interest rates. In fact, the lowest interest rate environment, folks, do you know this is the lowest we've seen since 1787? Put that in perspective for a minute. I mean, that's the history of our country, basically. And we are in the lowest interest rate environment for one of the, if not probably the longest period of time ever in the history of our country. If not the longest, absolutely close to it. So this historically low interest rate environment has definitely created a situation where it's lower cost of borrowing. Lending borrowing is super cheap. Money is super easy to borrow. The price of it is cheap. We'll put it that way. And for those with good credit, obviously been able to take advantage of this. I mean, I still remember when a normal mortgage was. I remember talking to people where a normal mortgage at 7% was considered a good rate. A 30-year fixed mortgage at 7%. Folks, that wasn't that long ago. That was prior to 0809. That was considered the norm. Now, I have clients, most clients are in the 3s, some even in the high 2% range. I mean, again, that's crazy. It's historically in a low point. What it does, though, is it creates a situation where, because it's cheaper to borrow the money, you can afford more. You can afford to borrow more, basically. You can afford more house, right? Which has created the price of the houses. It costs prices to go up. It's created a bubble, if you will. The Fed, by purchasing these mortgage-backed securities at $40 billion a month, by the way, since mid-2020, has caused, in my opinion, a bubble in the value of real estate. We've seen all-time highs in many, many places. The $80 billion of bonds that the Federal Reserve has been buying since mid 2020 has also helped create a stock market bubble. Asset prices, stock prices being, breaking all-time highs on a regular basis. Stratospheric, right? And if you're invested in this stuff, that's been great. But again, this isn't fear talking. I'm not fear-mongering here. I'm just being realistic historically. What goes up must come down. Cycles happen. Things happen. And with the fact that the Federal Reserve has now announced they're going to start tapering, which means they're going to start reducing the amount of bonds and mortgage-backed securities they're going to purchase each month starting November of 2021 and finish purchasing these assets by June of 2022, that means these markets are going to be more on their own. They're not going to have the cushion of the Fed there as a consistent, regular buyer of these assets. Most experts agree it's going to have an impact on stock market values. It's going to have an impact on real estate values. To what degree? That remains unknown. We're almost in uncharted water. This type of stuff has almost never happened. This is part of my issue or beef with what I consider an overactive government or quasi-government entities inserting themselves in the economic system. They do this to help, and certainly they can have an impact and even in a short-term manner help, but then also typically by staying too long, as I said in the first statement, can create an asset bubble, create a bigger problem than they were trying to solve. Is it going to create a significant correction in the prices of these assets, the stock market and the real estate market? Don't know. Hard to say. Impossible to determine. And if anybody, I want to say this much, if anybody thinks they know, again, we're in almost uncharted territory here. Our Federal Reserve's never had a balance sheet. In other words, they've never had this amount of assets ever before. They're going to stop. Here's the other part of the picture, folks. Just because they stop buying these assets and dwindle down the buying of assets, then it's on their balance sheet. They own all this stuff. Now what? How are they going to start unloading some of these assets at some point? Or are they going to be able to? So it's a bigger picture than just the assets that they're buying, the mortgage-backed securities and the bonds that have been buying for each month. And then if they stop buying them, okay, fine. The other aspect is interest rates. They have that lever of raising or lowering interest rates. Of course, they're at all-time lows. They have stated, this is important to know, they have stated they're going to keep those interest rates low, probably through the end of 2022, maybe into 2023 even. So we're going to have an interesting situation where we might see, again, I say might, this is all conjecture, we might see corrections in the stock markets and real estate markets in pricing, that is, yet the cost of borrowing might still remain quite low, which is beneficial typically to business and real estate. So you got two things going on here. They're contradictory, right? But then what happens looking down the road a little bit further is the Fed just going to continue to hold these assets indefinitely, or are they going to start to try to sell them at some point? I mean, the amount of assets that the Federal Reserve holds currently is unprecedented. Never in history anything like it. What then? What happens when they start to try to sell some of these assets? And I mean, now instead of becoming a buyer on a regular basis, then suddenly or start becoming a seller. Economics 101 tells us, more buyers, prices go up. More sellers, prices go down, right? That's, again, economics 101. My point is quite simple. There is a lot of uncertainty. There's a lot of uncharted waters here. And again, I'm not fear-mongering. I'm not trying to scare anyone. I'm just trying to give some, what I've seen in my roughly 25-year career in the financial world and as a fellow business owner, entrepreneur, is having diversification is one of the best ways to offset uncertainty and uncharted waters that we are definitely treading right now. We're swimming through uncharted waters. What's going to happen? And then we don't know. Diversification into your personal bank policy that's non-correlated, has nothing to do with the stock market or real estate markets, for example, can be a very wise move. Contact me at yourpersonalbank.com or toll free 866-268-4422 for more info. Also, I haven't talked about this so much, but we'll touch on this, I think, more in the next segment, is taxes. Because I think this is I mentioned this briefly in the first segment, that we're now in a political situation where I believe we're at an inflection point. The current administration certainly has pushed some very, very radical agenda and major changes compared to what we were dealing with before by anyone's stretch of the imagination. There's been a major pushback in these recent elections, like in Virginia, etc., but literally, frankly, all over the country. A year from now, we're going to have midterm elections. And is this impetus going to continue? In other words, is the current administration going to make an adjustment to their what they're doing, their agenda, or are they going to change course? Is there going to be a significant changing of course? I'll share that in my next show. Some more opinion on that. I want to think about that one a little bit more. My initial reaction is, I don't think so, but initial knee-jerk reaction isn't always what end up happening, right? So what that does, it creates a lot of uncertainty with tax policy. So I'm going to really encourage you to stay tuned to the next segment, because I'm going to talk about a little bit more of that, the impact of potential tax law changes, and what you can do to protect yourself. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. Well, today we've been talking mostly about the recent Federal Reserve announcements. Twofold. These are major announcements. They've been anticipated for quite some time, but it's still a big deal. And they have announced that they are going to start tapering purchasing of assets in November 2021 and finish tapering the purchase of those assets in June of 2022. Now, when I say that, and then the second thing, I'll explain it further in a minute, also they're going to keep interest rates at their current lowest historic low levels, probably through end of 2022 or early 2023. That's their most recent announcement. Both of these are a very big deal for our economy, for investments, for real estate, the stock market, and a lot of investments. Because as many people have always said, don't fight the Fed. We've come to learn that. Now, when we talk about tapering, a lot of people just don't really understand what that means. And frankly, it's really not that complicated. If you do, bear with me for a minute and we'll move on to some other good stuff for you. Tapering just means that in the middle of 2020, roughly, the Federal Reserve, due to the COVID shutdown, started purchasing $80 billion a month of bonds and $40 billion a month of mortgage-backed securities. Both of these, being the Fed purchasing these assets on a regular basis, was to provide liquidity in the market, stability, and all that kind of stuff because, our economy was in an economic free fall because of the shutdowns. Well, they've continued to do that even though their economy has, many parts of the country have come back. The economy is moving again, things like that. And in my opinion, they've continued to purchase these assets for far too long, creating another problem, which is an increase in pricing. There's several reasons why the stock market has been breaking all-time highs on a regular basis, and real estate has done the same. But certainly the Federal Reserve purchasing these assets that support both of these markets has been a big contributing factor. I don't think anyone can argue that. When they start tapering or purchasing less of them each month and then stop after June of 2022, how is that going to affect the prices of real estate? How is it going to affect the stock prices of the markets? Certainly, my opinion is it's going to have an effect. I think most people agree with that. How much of an effect is really truly the uncertainty here. And again, these are uncharted waters. We don't really know we've never really been here before, so to speak. So there's really nothing we can go back to and say, well, this is how it worked last time. So a lot of uncertainty. I talk about diversification, and your personal bank is a solution for that. Again, a non-correlated asset that not related to the stock market or real estate markets. It has consistency, guarantees, been paying dividends since literally before the Civil War, but also happens to be tax-free. Now, I'm going to share a little more on this. If you want to contact me with more information, contact me at toll-free 866-268-4422 or yourpersonalbank.com. But the thing is, we can set these accounts up so the money you're earning dividends. Like I said, we got companies been paying 6% plus dividends last 25 plus years. I'll show you all the top dividend payers, and literally have never missed paying a dividend since before the Civil War. Okay, well positioned to continue to do so for the next number of years. Well, frankly, a lifetime. Okay, that's the kind of reserves these companies have to be able to pay these dividends. But for some people, most importantly, this is tax-free. So again, another diversification strategy. I was talking about earlier where you can diversify into a non-correlated asset. In other words, an asset that has nothing to do with the stock market or real estate market. That's a smart diversification strategy, okay? But you also, tax diversification is key. A lot of people I talk to have a lot of their money tied up in IRAs and 401ks and those types of accounts, qualified accounts, that of course are 100% taxable. The traditional ones are 100% taxable when you access the monies, when you take the withdrawals. Well, that puts you at risk to future tax policy. If they raise the tax rates in the future and a good chunk of your money is tied up in those kinds of accounts, you're going to be stuck paying whatever tax rates our Congress deems, puts upon us, right? In other words, you're totally at risk. You're totally at the whim of Congress in terms of how much you're going to pay in tax if most, if not all, your money is tied up that way. So creating, and I always say, how much do you trust Congress? We won't go there right now. But creating a diversification bucket, a bucket that's tax-free, so you don't have to be locked in or at the whim of Congress for future tax rates to give you some options. Folks, that just makes sense. And given the level of debt that our country already has, not to mention if they spend more, who knows, then that tax bill could be significant for a lot of people. So if you want to figure out how to create that diversification and give yourself some options in terms of a tax strategy and how much you pay in taxes going forward, irregardless of what Congress does with tax rates, contact me at toll-free 866-268-4422 or yourpersonalbank.com. Stay tuned in the next segment. I've got one more last thing I want to talk about today, and that is inflation and how the impacts that I see on those things going forward in the near and longer term future. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Well, we have been discussing a lot of exciting topics today, mostly revolving around the recent announcements by the Federal Reserve. And of course, that has to do with, diversification, interest rates we've been discussing, tapering of assets, taxes, future tax policies, and things like that. Of course, I want to discuss in this last segment, inflation. Now, if it sounds all boring, or for some of you it's not, you love it. You love this stuff. That's great. If you missed it, go to yourpersonalbank.com. You can listen to any of the previously recorded shows. For those of you that this all stuff sounds kind of boring, give it a minute. I try to explain these things. I've been told this. I have a knack for taking things that might be kind of boring or complicated and boiling it down to simple terms, and it makes sense and kind of enjoyable. So give me a chance, I guess is what I'm trying to say. The one I want to talk about now is inflation. And of all the things I've discussed already, the tapering, the interest rates, taxes, folks, this one might have the biggest impact on the average individual. And why it is inflation often is called an invisible tax. It does impact the middle and lower classes the most because their percentage of their income the lower your income, the higher the percentage of your income is used to purchase the necessities of life, things like food and gas and heating and all those kinds of things. And so when the cost of those things rise, it impacts somebody with a lower income more than a higher income because, again, a higher percentage of your income, a higher percentage of your money is going to those things. So the thing is about inflation, it's an insidious thing. It's really difficult to it's kind of like it's one of those things where an ounce of prevention is far more effective than a pound of cure. So in other words, once it gets started, it's kind of like a cold or a flu. It's a lot easier to get it really quick early on and, take some vitamin C and zincs and stuff like that and try to knock it out before it gets started than it is after it gets a hold of you and now you've got to go through the whole process, right? It's kind of the same thing. And so unfortunately, inflation has already gotten a hold of our country. Look, folks, here's the thing. We're in an inflationary situation. Inflation is at the highest rates recorded since the 1970s. That's a fact. Those are documented facts. Certain areas that are being impacted by inflation, and again, there's a number of reasons behind it, but things like meat and gas are two of the things that have been impacted the most. The other problem I see with inflation and with the increase in the cost of some of these items is the longer term effects. Not always, but typically when the price of something goes up and people start kind of get used to paying that higher price, it rarely goes back to where it was. It's kind of like it's called the rubber band effect. In other words, it's like a rubber band. You stretch the rubber band initially. When you first pull a new rubber band, it's resistant. It's tough to pull. You know what I mean? So the resistance is in the initial stretch or the increase in prices, stretching to pay that much more for that hamburger or that gallon of gas or whatever, right? That's the most painful. But if it goes back, you notice a rubber band, after it's been stretched, it typically doesn't go all the way back when you let it take the pressure off. It doesn't go all the way back. It'll retreat some, but it won't go all the way back to where it started. And that's often the case with prices of goods and services. Again, it's a psychological human nature type thing. And companies recognize this, that once you get past that initial resistance, that initial stretch of increasing the price, then when whatever caused that increase, that inflationary increase in the price, it'll come back. It'll retreat back like that rubber band, but rarely does it go all the way back to where it was, unless there's some strong impetus to push the price down, like an overflow of, all of a sudden we have a glut of gas, we got too much gas, okay, then you can see that happen. But that's less common, right? So what my concern is, people start get used to paying more for meat or something, for example, and then we'll never see the prices we saw for hamburger, for example, we saw 6 months ago or a year ago, maybe ever again. So it's a lot of times inflation, in essence, becomes a long-term, almost permanent tax or an invisible tax on people, and again, tends to impact the middle and lower classes even more so than folks that make more. So there's an article here. It's quite interesting, actually, that I was reading, and it's the title of the article is "Former Obama Auto Czar on Inflation. Americans are losing purchasing power and are really unhappy about it." And what I just shared with you is the reason why. I mean, no one likes to pay more for stuff than we're used to paying for it. It's just there's nothing fun about it, okay? We work hard. Most of us work hard for our money, okay? The vast majority of Americans do, okay? And then to have to pay more for something that's a necessity, like you need gas to get in your car to go to work or go to your business or whatever, maybe you can drive less, but it's still a necessity. You still got to get around sometimes. And if you have to pay more for it, there's nothing fun about that. But what was interesting in this article is they were talking about a study, a poll was done very recently, said 89% of Americans said they were very concerned about the economy. And also the poll stated that half Americans expect the economy to get worse, not better, over the next few months. I think they're right. I mean, the things that are happening with the supply chain issues, with the labor shortage, Frankly, with our government still paying far too many people not to work, okay, again, it may not be politically correct, but folks, it's a fact. It's a documented fact. In fact, this trend, I've seen many other studies on it, this trend of fewer and fewer people working has been going on, not in just this last year or so. It's been going on for decades. It's exacerbated or accelerated in this last year or two because of the COVID shutdowns and the additional monies and benefits. There's something like, I just saw an article, there's over 70, did you know there's over 70 different programs, social programs out there for people to get money and subsistence and whatever, government programs. 70. I had no idea. Okay. Now, I'm not saying we shouldn't have a social safety net for those that fall under hard times or for mental or physical reasons or are disabled or unable to work or whatever, support themselves. I'm not saying that. But our society, it started with Lyndon Johnson, the Great Society. Since that time, it's historic. The numbers don't lie. More and more people gradually have chosen not to work because they're basically getting supported. They're what's the word? They're dependent. It's become a dependency class, basically dependent on the government to give them everything. And folks, even the National Park Service understands that's not a good idea because they have signs in their parks that state don't feed the bears because they can become dependent, right? So it's kind of funny, but if you just feed the people and take care of their needs and don't require anything from them, some of them are going to become dependent, aren't they? It's just human nature. In fact, it's animal nature, obviously. It's not a good thing. Long-term dependency for able-bodied people is not a good or positive thing. And if you want to see the real effects of it, I live in Arizona. Go to any Indian reservation. Just go to it and drive around, look around. I shared this earlier where my mom taught for several years on the Navajo Indian reservation. And I was just talking to her about this last night, in fact, where I remember visiting her there a few times and talking about so many of her students. And like she said, it was such a hopeless environment, society. A few lifted themselves up out of that, but most, there was just a hopelessness. There was no hope. As she put it, she tried to inspire a kid to maybe go to college or do something more because they had the aptitude. That wasn't the problem. Scholarship money was available. The avenues were there, but their response was, why should I bother? I'll probably never be accepted or whatever. There just was a lack of hope. And folks, when you don't have hope, you die. You kind of die inside. A part of your soul just dies. And what's sad, I believe, is that our government has been a big cause and proponent of creating a dependency class of many people. And frankly, it's just cruel. It's cruel. Some hope needs to be instilled in there and some requirement for those that can do something for themselves, because then if they do something for themselves, they'll gain a sense of achievement, a sense of accomplishment, even if it's something small, and then that can be built upon. And then eventually a person can move out of a dependency cycle and into an opportunity cycle. I mean, the other side of it is, look at all these, throughout history of our country, look at all these people with the opportunities. We've been known as the land of opportunity for couple hundred years, and look at all these immigrants that come legally from all over the world, different parts of the world, my own family included, work hard, do well. It's a land of opportunity, right? And make something of themselves, and they build businesses, and they take care of their families, and they buy homes, and they do all these things, and they work hard and recognize the opportunity because they have hope. They have a hope for something better. See the difference? That cycle of dependency where there's a lack of hope for something better versus a legal immigrant that comes to this country, does it the right way, and works hard and takes advantage of the American dream and accomplishes something great for themselves and their family. Okay? I kind of got off track there a little bit, but again, I think that's so important to understand that this inflation thing is really insidious because it can really push some people down that are maybe on the verge of doing something, but that this is going to be, the cutoff's going to move higher, right? Because they're going to spend more of their money on food or gas or heating or whatever, and they're not going to be able to take advantage of that class that might have got them that better job that took them to the next level or start that business or whatever it is. And that's what's so sad about inflation, what makes it so insidious. So one of the things you can do, people ask me this all the time, what can I do to help offset inflation? Well, have an inflation-resistant, interest rate-sensitive asset, for example. If you're going to put some money away, look, if the markets, the markets and real estate markets, the stock market and real estate markets might be having some choppy waters ahead because of the tapering of the Fed and things like that, not buying as much assets. Diversification might make some sense. You're concerned about future tax rates going up, which could likely happen. It's hard to say. We're going to see what happens. But contact me at 866-268-4422 or yourpersonalbank.com because I can show you how to get into a interest rate sensitive asset. The money will grow consistently every year, irregardless of what the stock market or real estate market does. Doesn't matter. And tax free, so it doesn't matter what our Congress does in terms of tax rates going forward. Doesn't matter. Okay. You're diversified, the money's available, and I haven't even talked about this in the show at all in this one, but we can create a positive cash flow even if you take the money and spend it or use it for other purposes. The money will still grow. You'll earn interest on the money that's spent, and I don't know of any other way for typical people to do that. So it's a way of gaining more control of your money, earning more on your money, so knows your money goes farther, which can help offset inflation. That's my point. Help you get farther down the road, farther, faster, and accomplish something that maybe you couldn't have otherwise. So again, contact me at toll-free 866-268-4422 or yourpersonalbank.com for more information. You'll get to talk to me, okay? And I'll be happy to discuss this with you, how we can offset inflation, taxes, interest rates, all those kinds of things, create diversification, and really enhance your financial future. That's the bottom line, right? And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.